Welcome to this Friday webinar. We
Yeah, hi
have been
Kamal.
hi Anirudh. So we have been doing webinars since 2020. You are the first earlier ones, Anirudh. If you remember, you had come to our office in
Yes, yes,
Gurgaon in 2019 or 20. We had done our first webinar. I think 2019 before COVID.
right.
2019 around May. We had discussed about your IFL multi-cap PMS in those days.
Yes, yes. So I think I had visited your office when I was in IFL. So that was
Correct.
pre-COVID.
Correct. So, I thought of doing this, webinar with you because you are one non-diplomatic and maybe a fund manager who I can kind of talk as a friend. And we want to do this as a free-flowing conversation because there are a lot of questions which investors would want to ask at these markets. So maybe, before I start, you understand the context, right? So you yourself are an investor. So let's maybe, keep fund managers hat aside, have our own, I would say, logic to it. But yes, what's happening in the market, our market is really going to give opportunity to investors to add more money, or this is like a time where one should not be kind of definitely not try to time the market even for a single day, because it's like a different kind of a bull run going on. So this time really it is really something which is different, and these four words are not dangerous at all. We should kind of not kind of go by old wisdom, because markets keep kind of thrashing old wisdom and maybe the new learnings are learned. So over to you. Maybe what are your opening comments? Let's understand first those.
Sure, sure. I would want to extend a warm welcome to all the viewers who are there at this point of time, who are live, and also who will be watching this video afterwards. I think one thing which has become very important to understand in India is that I'll again take kind of an extension of what you just mentioned. This time it's different. That over the last 4.5 years, why I'm saying 4.5 years is because this is the time since the COVID started. Over the last 4.5 years, a lot has changed in the world. And when I'm saying in the world, it includes different countries, economies, the geographies, and definitely within that entire basket within India. Now, this has been kind of a rally. If I see the last many kind of the quarters, last 4 quarters, last 8 quarters, the type of rally which has been there, it has caught everyone unaware, because everyone was thinking, I think it's over and done, valuations are rich and all. But I think it's a bit different from a very fact that India's position on the world stage has changed drastically. And it's not just about India's position in the world stage, it's also about what is happening within India with regard to multiple aspects, whether you talk about manufacturing, you talk about the political landscape, you talk about making in India becoming a reality. I think multiple things are changing and have been evolving over this period. Now, if I just go back and see in the last 8 quarters, what was the concerns in the market? Like, if I look back in the last 8 quarters, most of the headwinds which we were there in the market, you had one of them was the rising interest rates, wherein you had the interest rates going up in the US, and along with that in India. Almost every month we used to hear the comments that, because of rising rates, will the FIs take out money from India? Will within India the asset allocation change, wherein you'll find more kind of acceptance, more kind of money flowing into the fixed income because of the rising rates. But we saw that all that, it did not impact the flows into equity. Second aspect, which was a headwind, was the rising inflation. Now, over the last 8 quarters, we had inflation as a big kind of a concern, and that was again something which impacted all corporates. Margins got impacted, businesses got impacted, even the households got impacted with regard to that. This was again the second headwind. The third headwind was with regard to the two wars which happened, one in Ukraine, one in Israel. If I see how the world adjusted to the two wars, I think one thing has become very clear, that economy and wars can go hand in hand. Earlier, if I go back and see, when we were in our initial days, any war happening in the Middle East, it used to kind of disrupt Indian economy left, right, and center. And because we were too dependent on everything happening in the Middle East, and with regard to oil and other aspects. So I think that was the third headwind of the two wars. Fourth big concern was about elections, and that was again not just about Indian elections, but also with the fact that 60% of the world is getting into elections in this year. So it was all about that the political landscape will change across the globe. Now, with all these kind of headwinds which were there for the last 8 quarters, now I would say all of them have become the tailwinds. Now, Interest rates have peaked out. We have seen the rate cuts in ECB. We have seen the rate cuts in a couple of other countries. US, most likely in the next couple of months, you would see the first kind of a cut. In fact, the US Fed, it gave an indication of a possible rate cut in September, October. So let's see how it works out. The second aspect was about inflation. I think inflation has also peaked out. We have seen inflation peaking out. The new normal is the 4.5% to 5%. That is the new normal. We can't expect to go down to 2.5%. So I think adjustment of economies, corporates, and households has happened to the new kind of a normal. Third, wars. As I mentioned, the world has understood that wars and economy can go hand in hand. So I think wars are happening in some part of the world, but economies are not getting disrupted. Supply chains are not getting disrupted. We often get to hear that there has been kind of a log jam in the Red Sea because of a shipping cost has gone up. But then we again find that there has been some alternative routes and some alternative arrangement has been done. We saw what happened with India also becoming kind of a destination for shipments. And the fourth aspect is obviously the elections. There's been a continuity of government, continuity of the cabinet, continuity of policies. I think that again is kind of a positive aspect. Now, all these headwinds becoming tailwinds has been a big factor why post-election you saw almost like a 2,500 points kind of a rally on the Nifty. And it's not a small number. If you get a 10% to 12% kind of a rally within a month or so, within 1.5 months to 2 months, I think that's a big number we're talking about. So I would say this is not the end of the rally. Now, coming to the point that where should investors head from here? I would say that the ingredients have all been put in place with regard to the very fact that if we have to reach a 5 trillion economy in the next 36 to 48 months, that works out to around 7.5% kind of an economic growth rate. Now, this number is going to be achieved only if we have all the building blocks in place. And I think the building blocks are in place, whether you talk about on the policy front, you talk about private capex, which has been a drag for a long time. I think public capex is what has been pushing the capex cycle. But I think private capex is what is the big number. If I just look at the numbers in the next 6 years, your private capex is going to be 4 times the number of the public capex. So that ingredient has again been put in place by keeping the tax rates low, by pushing SME loan, MSME kind of a lending, government giving a lot of support for MSME growth, which has been a drag for a long time. And I think the budget has also kind of put a good impetus with regard to one big concern in the economy, which I think we can talk about is job creation, which has been a very, very big aspect of, job creation being not sufficient enough to take care of, the number of youth who have been there, and also upskilling of the youth. Along with that, I would say ultimately it brings down, the market views to the fact that where can the earnings come from. So I think earnings growth is where all the attention has to come to. Wherein I've been telling investors that that easy part of money making is behind us now. Last 4 years, everyone under the sun has made money. Some have made more, some have made less. But I think that easy part of money making is behind us. Now it will be more of a very not I would say impossible, but it will be more selective of which sectors, which companies you're betting on, and which sectors, which companies you're avoiding. Just to give you a glimpse why easy money making is behind us. 6 months back, almost 68 to 70% of the small cap companies were outperforming the small cap index. That number has now come down to almost 25 to 30%. Which means that earlier 65 to 70% of the companies were outperforming the index. Now around 25 to 30% are outperforming the index, which means a large part of the market is not doing better than the index. And hence people have been complaining that, small caps or XYZ is overheated and valuations are rich, so we should exit. So I think easy part of money making is behind. And I think it's going to be very important that, picking up the right sectors, the right companies, and more importantly, keeping an eye on the valuations. I have been telling investors that it's a time to gradually deploy more, because I think we are going to reach the 5 trillion. We are going to be among the top 3 economies, and I think there is no question that Indian markets can't give you a double-digit kind of a return over this period.
Sure, Anirudh. So all this is like, something which all the more, I would say, irritates those investors who are sitting on the sidelines and who have been waiting for market to fall. And now, maybe it looks and seems that that money, which is like been patiently waiting based on past experiences that equities do fall, is like now becoming impatient. And that money is something, which is going to, I think, find its way in the stock market over next maybe couple of quarters.
It's happening. In fact, I would say that we don't need to wait for the next couple of quarters. Like if you see the way the money has come in the market in the last 60 days, I think it's a huge number. And SIP numbers, we all talk about it. We all kind of, have been very happy about the way the SIP numbers have been flowing. But I'll just give you a glimpse. I'm sure you're aware about the data. Many people on the call will be aware about the data. I think Indian investors, the retail investors, HNI investors, they have really matured. Now, I would say hats off to the retail investors. We used to always make fun of the retail investors that they come at the peak. Institutions, they come at the bottom and sell at the peak, and it's the retail guys coming at the peak. You got a glimpse of that on the exit poll day and the actual result day. On the exit poll day, you had your institutions, they were buying, and the retail investors were selling. On the actual election result day on 4th of June, you had a FI sell figure of around 14,000 crore, domestic sell figure of around 6,000-7,000 crore, and the retail investors bought 22,000 crore. Now that shows that on a day when the panic hit the roof, you had the retail investors, HNIs buying. That was a glimpse of the amount of money which is waiting to enter. Pre-COVID, we had roughly 4% of the households participating in equity. That number has now gone up to around 10 to 12%. And I would say we have a long way to go, because with the arbitrage between the different asset classes which has been removed in this budget, because as you know that in Indian household, still 70-80% of, not 70-80, much more than that, the net worth was locked up in the real estate and gold. Now with the arbitrage of indexation going away from the real estate, I think we are just looking at bigger numbers of money flowing into the equity markets in the coming years.
So, while things and story in India is like looking to be quite interesting and long term, and we have always been waiting for this structural bull run to happen in India, and maybe this decade started with that, and this will continue. But at the same time, it looks like that the western part of the world and their economies and their stock markets are like maybe either at a juncture or staring at some correction, and all that is like looming as a risk, which is an opportunity for investors who kind of add more. So what are the kind of updates on that, and do you think that is going to become as big a risk as we have seen in the past, like which led to the sentiment turning against equities, and many of these domestic investors who have been kind of keeping a kind of a cushion and giving cushion when FIs are pulling out, even that gets taken away?
See, with regard to the Western markets, I would say that if you look at the US market, so I'll talk about the US market. Now, the US market for the last couple of years, it has been only the top 7-8, the top tech stocks which have been pulling the market. And whether it's, your Nvidia's, Tesla, Apple, Microsoft, Alphabets of the world, that is what was pulling the market. Now, if you see what has changed in the last couple of months, or rather in the last 1 or 2 months, is that the breadth of the market has improved, which is the top tech stocks, they have been declining, whether it's Tesla or you can talk about any of the other companies, they have been declining. But it is the Russell 2000, that makes up the small cap companies. And in that, what you have is most of the old economy companies. They have been doing well. And in fact, that has outperformed the NASDAQ and the Dow also. So the breadth of the market is improving. Now that is happening with a lot of expectation that Mr. Trump is going to come back. He focuses on Make in America. And that is where the old economy companies will do well. And it is the tech stocks which are declining, because the tech stocks typically don't favor kind of the Make in America. But that is where the focus goes back to the manufacturing industries. So I would say that it's a realignment of sectors and companies which is happening in the US market, and because of which I think some sort of the correction is visible. The correction which we saw most recently yesterday or maybe this week is all to do with what is happening in Middle East. with regard to the Israel attack on the Lebanon and Iran. I think what we were kind of hearing is that, over the weekend, you'll find some attacks from Iran and things like that. I don't know what happens or what does not happen. We had a glimpse of this again, the first attack which happened, in which Iran attacked over the weekend. Both sides attacked each other. They had their anti-missile things, and there was not any casualty. It was all over and done within 24 hours. So we'll have to see whether this this issue of Middle East crisis escalates and becomes a bigger concern. But as of now, it does not seem to be. So I would say that whatever reaction we are seeing in the market is more of a short-term reaction. Fundamentally, I think there's a lot of kind of the rebalancing which will happen even within emerging market allocations. For a simple fact that within emerging market allocation, we have seen in the last 4 years, India's weight in MSCI has gone up from 8 to 17%. So there's a pretty large jump of India's weight increase. Now, this has definitely come at the cost of other emerging markets which have not been doing well, and also with regard to the Chinese economy not growing to the extent which it was growing in the past. So I would say that I don't see any reason of getting worried with regard to the Indian markets. There could be the small blips. Markets cannot keep going up every day. There has to be corrections, both time correction and price correction, and those are corrections which always, I would say, they put the boat on the right course. So I would say that it's good to have the small corrections. Otherwise, you don't have your feet on the ground. As I mentioned, that when everything goes well, everyone is making money. Money making becomes easy. So I think small corrections are always good. Getting a 1,000-point Nifty correction in a week is not a big thing today. So 1,000-point on Nifty is like just 4%. So 4% correction on Nifty in a week is not a very big thing. So I would say small corrections will be there, but yes, I don't see any major concern of Indian equities getting impacted in a big way. Now, within that, you need to focus a lot on the sectors. Now, that is where all my emphasis has been always. So sector rotation as a style, if you remember, sector rotation as a style has been, what has been my the main focus area over the years. Now, I would say one needs to focus on whatever is happening within the country. And that's the reason, if I look at my portfolio also, bulk of my allocation is into these couple of major themes. One is urban and semi-urban consumption. Second is private and public capex. And third is the financial services. Now, when I say financial services, it includes not just banks, but other financials also. So I think we'll have to be very aware of which sectors we are betting on. And I don't see a reason why, you can't, make a mid-teens to high double-digit to high teens kind of a return, even in a market which index-wise might give you the high single-digit kind of a return. The other question actually which keeps coming up is what would happen with the flows if the rate cycles change. Now, that is again going to be a positive factor. Like if you see the interest rates getting cut in the US, I think you will find money flowing to the emerging markets more. And the very fact that I mentioned that, India's weightage has increased in the MSCI index for emerging markets, I think, which means a bigger chunk will come to India also. Only debate keeps on happening is about the valuation. I think valuation India has remained expensive. India will remain expensive for the very fact that if you look at corporate earnings, there's no economy in the world where an economy of our size with companies of our size, you are seeing corporate earnings grow at 15 to 16%. So this type of earnings growth, it will command a premium, and that is the reason you will find India also being at a premium to the other emerging markets. In fact, just the other day, we were just discussing that over the last 6 to 9 months, a lot of discussion used to happen that we should make allocations towards Southeast Asia. So China, Hong Kong, those had become kind of interesting destinations for investment because purely from a valuation perspective that they had gone through a massive time correction, price correction, and it's a good valuation, and it was being pitched against India's valuation. So I think it was being pitched against India's valuation, and that was something which many people were kind of wanting to do. Now, if I see in the last 6 months, China has underperformed India big time. So I think it again shows that an expensive stock can continue to remain expensive, and expensive economy can continue to remain expensive as long as the earnings are growing much faster.
So at this juncture, when you are managing your sector rotation oriented portfolios, so one thing, which I see, I really kind of appreciate and like that sector rotation style. We have been seeing, markets now of late giving thumbs up to some of those sectors like specialty chemicals or private banks, which have not run up over last, rally. And it somehow at times one obviously finds comfort in getting into those stocks like HDFC Bank or maybe Aarti Industries or something like, within the specialty chemicals, other such stocks also. But at the same time, it also feels that maybe there is so much liquidity flowing in through DIIs at the moment that if it cannot find more way to some of the other industries or other sectors which are actually supported by growth in earnings, it is finding its way to some of those ignored sectors or ignored stocks which maybe are not that much supported by growth in earnings, but there is an expectation that now these stocks are like they have not run up and maybe next rally they will participate. Now, if we have to actually comprehend from fund management point of view, and you are obviously, at the helm of the things where you would know how our kind of current results are looking like, and what is the reality of how various sectors are showing on ground in terms of numbers, in terms of corporate earnings. If we have to discuss that, and then we have to kind of comprehend that yes, these sectors are the ones, or within these sectors, these are the stocks which are really relatively, I would say better placed given growth and value, given I would say valuations as well as their expected growths.
Yeah, sure. So I think you mentioned about the chemicals as being one space. I would put other two sectors, which is pharma and IT. So pharma, chemicals, these two have been sectors which have been underperforming for a long time. And they have seen decent valuation correction, time correction, and price corrections also. And IT has been one basket, which has again kind of gone through a period of underperformance and multiple contractions. Now, I have been underweight on pharma, chemicals, and IT for almost 6 out of the last 8 quarters. And over the last 1 or 2 quarters, we have been building up IT, pharma, and chemicals, all of them. Now, when it comes to chemicals and pharma in specific, now what has changed is valuations of these companies during the COVID had gone up over the roof. And, for obvious reasons, you were seeing a lot of import substitution happening in the chemical companies. Chinese plants were shut. Logistic prices had gone up like 6-7x. So it had become unviable to import. So import substitution was a big theme that time. Now, because of that, and along with that, the margins which these chemical companies were making was again at all-time highs. So hence the multiples they enjoyed was again at an all-time high. Now, unfortunately, what the market did is they extrapolated those multiples and those earnings and those margins to over a longer period of time. Now, it doesn't work out that way. Now, when the supply chains opened up internationally, that is when the prices corrected for the chemicals. You saw the margins declining and oversupply hit. Chinese companies, they started dumping again in the global market, and import substitution, which had become a big theme, that again, I would say it lost its attractiveness. Now, where we are today, I would say bottoming of the chemical sector has been done. It's not that, you will see kind of a massive upcycle from here, but yes, it will be a very selective kind of an upcycle for different chemicals. So I would say that we are betting on some of the chemical companies. We have just 1 or 2. So I'll not be taking names of any companies because of different the regulatory reasons. But I would say that we already have a small cap chemical company in our portfolio, which is into a very specialized area. And we are also evaluating a couple of small and mid cap chemical companies where we are seeing the margins have improved, the spreads have improved, and also supply chains which got disrupted massively in the past, they have been restored. So wherever we are seeing these things matching along with the valuation, that is where we are taking. One thing in this you have to keep an eye is that there were some chemical companies like which were in the fluorochemicals and all, wherein the US, which was a large market, they had put up a lot of anti-dumping duty on the Chinese. That had been revoked over the last couple of quarters. So hence Chinese supply went back. Again, with Mr. Trump coming back, he is always been, as we know, he's always anti-China with regard to imports. Now, whether those things again come back as a strong anti-dumping duty, we'll have to see and play out. So I would say the whole chemical sector is not something you can bet on blindly, but it has to be very selective in which companies and which product in the chemical space you are betting on. Pharma is again another space where I would say one needs to look at making allocation. We didn't have any pharma, as I mentioned, for almost 6 out of the last 8 quarters. But again, last 2 quarters, I have increased my pharma allocation to 6 to 7%. From not having any pharma, we have got it up to 6 to 7. I am looking at making it up to around 8-9% also, because I think in the pharma industry, what has happened is earlier the concerns which was there with regard to the margins, US FDA approvals, pricing pressure in the US market, domestic competition. I think all those are again now, I would say they have not gone off completely, but they have improved a lot. And along with that, typically what happens is when the interest rate cycles, they take a turn, the rate cycle goes down, you find the budgets for the R&D also going up. So that again works good for Indian companies who do a kind of a lot of discovery drug molecule R&D work for the global companies. So I think pharma is again a space wherein it should find allocation in client portfolios. Investors should be looking at making allocations to the pharma companies. Within pharma, I would say be in companies where there's not too much of US FDA hassles. Any company which has too much of a bad legacy of too much of the run-ins with the US FDA, one should avoid. And one should look at companies where the product pipeline and approval pipeline is much better. And also more importantly, where the balance sheet is very strong. So both chemicals and pharma, I would say it's a time to definitely look at and adding in the portfolios. IT is again one sector wherein I think the worst is behind us. From being an employees market, it has now gone back to becoming an employers market. Attritions which had gone up to 18-20%, they have again come off. Margins have bottomed out. They have seen improvement in the last couple of quarters. Deal pipeline, which was not very healthy, has improved. Execution of those deal pipelines was a big concern. I think that has also gradually picking up. I won't say it has picked up in a big way, but yes, in small pockets, execution of those pipelines has improved. So all in all, I would say IT along with pharma and chemicals are sectors which we have been avoiding for a long time, but now last couple of quarters we have been adding.
Sure. Also, you have explained pharma in quite detail. IT is another sector where I would want you to maybe cover with examples, because I have been seeing kind of mixed opinions from various fund managers. Various fund managers say that IT is like not yet bottomed out and earnings growth is not going to come very soon because earnings are dependent on the Western world. But at the same time, there are various fund houses which have been coming up with NFOs linked to IT as a sector. But what is the reality? We have seen IT sector also kind of recovering from its bottom. I'm talking about few stocks that I have been kind of tracking. But what are your views going ahead?
Yes, as I mentioned, IT definitely, I think it is out of the woods. I would not be I would be in the camp saying that avoid IT a couple of months back. But as I said, in the last 1 quarter, we have been adding IT because see, it's very difficult to catch the bottom. You can't get everything at the bottom. You have to get it at a time when you see the signs of improvement. If you wait for a time when everything has become good, then definitely you will have to pay a high price, high premium. So I think things have definitely bottomed out. I don't see margins getting worse from here. I don't see attritions getting worse from here. I don't see employee costs becoming worse from where it is today. And with regard to the discretionary IT spends in the US, I think economy is definitely doing very well, both in US and in Europe. In US, it's doing very well. In Europe, it's not doing so great. But yes, I think gradually that is also picking up. With the rate cycle taking a turn, you will find the IT discretionary budgets also picking up. And I would be in a space right now wherein you need to start looking at IT companies. You can't avoid. But then again, there's a big discussion which happens between the large cap IT and the mid cap IT. Now, in that whole debate, you'll find many of the mid cap IT companies, they have been growing much faster than the large cap IT companies. Now, that again gets factored in their multiples. Now, if you look at some of the mid cap IT companies, they quote at almost double the multiple of the large cap IT companies. So I would say that, one needs to weigh between the mid and large cap ITs, where the multiples and the growth numbers are in sync. Now, the biggest issue which happens in an expensive IT stock is that 1 or 2 quarters of earnings miss, market gives you a massive punishment. markets are not very kind. Any miss on estimates, any miss on expectations, you get punished immediately. So that's a big pain point when you buy into an expensive company in this type of a market. So I would say that yes, IT, I have turned bullish, but when I say I have turned bullish, it's not a broad-based bullish, but selective bullish, wherein valuations are justified by the earnings revival.
While we are doing this webinar at a juncture of India, August as a month started at kind of peak, which is a new all-time high that we have set on Nifty is 25,000, right? I know things are like quite bullish, and if any fall comes over next 10 days, 20 days, 30 days, it is going to be an opportunity to invest. And maybe fall will not come because a 2, 3, 4% fall will be bought over because there's so much liquidity, and that will not let fall to happen. But having said that, fall will definitely come. I'm telling you, fall is something which when it is least expected, it's going to happen then.
Absolutely.
So if you were to kind of guess how will be the fate of equities from here onwards for next 12 months as a fund manager, right? So if you have to kind of levels, it's like absolutely difficult. I know I'm putting you a very difficult question. I cannot ask this question from a very big fund manager because they will kind of say that it is a question they will never answer. But still, this is a question which I expect you to answer. I know it's difficult, but do give it a try.
See, I'll answer that question saying that, you actually answered that question a bit in your question itself, that, any fall is getting bought aggressively. Now, if I see the last couple of months, there have been many investors who used to say that, we'll deploy money once the elections, the results happen. There's going to be extreme movements and we'll wait for the elections and then deploy. You just go and see how many of them deployed money on 4th June or 5th June. People are waiting that, markets will fall more. They ultimately deployed when the markets bounced back. Again, on the day of the budget, you saw the wild swings in the market when, LTCG and all those announcements were happening. But then by end of the day, everything was fine. And by the next day, we went up and, everything is back to normal. In fact, I saw many people were a bit shocked that, in spite of the LTCG going up, markets are up. How is this possible? Because in 2018, when, LTCG had come, markets had declined sharply. So I think the question one needs to answer is that what is your alternate avenue of investing? Like if you have 100 rupees to invest today, where do you invest? So equity becomes an inevitable allocation in every household now. Now, with regard to the corrections in the market and next 1 year where the markets are headed, I would say that it's not going to be an easy walk, as I mentioned earlier. But what will happen is because of the US elections, because of Israel conflict continuing, you will see kind of a volatile market. Having said that, I would say in the next 1 year, if I look at the multiples of the market, 1 year forward, index is quoting at around 21 to 22p, which is not cheap, which is not very expensive. We are just one standard deviation above the historical average. If I look at the last 10 years, 1 year forward multiples, we are just around one standard deviation above the historical average. So I would say that we are not very expensive, we are not very cheap, but then again, the point which is supporting is the earnings growth is there. Earnings growth will be less compared to last year because last year the base effect was very high. So last year's base is pretty high. So compared to last year, the headline index earnings, when I say headline index, I'm talking about NSE 500, BSE 500, you will see that growing at around 11-12%. Last year we had around 17-18% kind of a growth. So yes, 11-12 looks weak compared to 17-18, but yes, base being higher, definitely this is kind of a year of the normalization. So I would say next 1 year, don't expect supernormal returns. If index gives you a single digit kind of a mid to high single digit kind of a return, I think that should be a very good kind of an outcome, because for an actively managed portfolio like ours, my objective would have been to at least give you a 5, 6, 7% alpha over the index return. So if your index gives you around the high single digit kind of a return, then making a mid-teen to high-teen kind of a return in an actively managed fund would not be very difficult. After a year of last year, I think everyone has made 40, 50, 60% kind of a return. I think after a year of making 40, 50, 60% kind of a return, getting a year making, mid-teens kind of a return is a very good year, because this is the year of the normalization. So next 1 year, it will be very important to manage your portfolio into the selective companies and not to go overboard and get into areas where too much of froth has already built up. Now, in that, I want to answer one point, which I'm sure it would be coming to your mind. And, I keep getting this question that, that everyone is saying to move to large caps. Everyone is saying markets will fall. Everyone is saying get out of small caps. Now, you answered this point yourself again. When everyone says that markets will fall, markets will not fall. When everyone says buy large caps, that's a time to avoid large caps. When everyone says exit small caps, that's a time to enter into small caps. In fact, I'll give you a kind of a small number from my own portfolio. In the month of March end, the large cap in my portfolio was around 47%, and small cap was around 39 to 40%. In the month of April, we saw a decent amount of noise with regard to small cap being expensive, with regard to the stress test for mutual funds, and we saw the small caps declining sharply in the first half of April. Now, against the broader view that large caps is the place to hide and small caps is the place to exit, I actually decreased my large cap and increased my small cap in the month of April. Because from 47%, I brought down my large cap allocation to around 40%. And from 39-40%, I took up my small cap allocation to 46 to 47%. So one needs to be very, very agile of taking advantage of such opportunities in the market. And next 1 year, I'm sure you will get multiple such opportunities of getting into the good companies at a good price, because extreme pessimism would have hit the market at some point or the other.
Sure, Anirudh. And I think now maybe everyone is perceiving the markets are not going to fall. In the rhythm of whatever you said, like saying whatever everybody is saying, something against is going to happen.
Yes. So we have in the market, when you expect the least, that is the time most things happen, and when everyone expects something, that's the time it won't happen.
So I know your style of investing is sector rotation. How do you fit stocks like Zomato in your strategy today, because stock has gone up, and I have seen that stock compounding from lows of 50 rupees to today 5x from that level. And then obviously I have seen few fund managers who totally had kind of know that we don't even understand some of these businesses and we will never touch. And some fund managers have this as a top holding. How are you placed in your portfolio style for such stocks, for such businesses?
I'm happy you asked this question on Zomato, because in fact, when investors, they look at my portfolio, they really feel happy that Zomato is among the top 3 holdings in my portfolio. And I've been holding Zomato as a top 3 holding for the last almost 8 to 10 quarters. And I was fortunate enough that we got into our PMS and AIF at around 50 odd rupees, the number which you mentioned, when you had those large PE deals which happened wherein Zomato was exited. So Zomato remains as a top 3 holding in our portfolios. And I would answer mentioning about the valuation for that is that one needs to sometimes look beyond just pure valuations, because it's a business. Now, this is something which we have been saying again and again over the last 8 quarters, that don't look at Zomato as a valuation game, or what should be its price to earnings, what should be its price to book. Just look at the business opportunity. Now, the 3 businesses which were there, one was the food business, one was your Blinkit, which was the quick commerce, and third is the Hyperpure business. Now, Hyperpure is a very small business as of now, so we'll not talk much about it. Now, when we got into Zomato, it was a food business which was the main business, and that was a time when it had just acquired Blinkit. And the opportunity which we saw, obviously in Blinkit, was not something which we are seeing now, because when we got into Zomato, there was no visibility where Blinkit is headed. So it was purely valuing on the food business. And then we felt that, 60 rupees, 60, 65 rupees was kind of a good price wherein the margin of safety is there. So that's the point when we, ventured there. And obviously, if Blinkit works out, that will be kind of an option value. Now, obviously, post-entry, every quarter, we have been evaluating the company as the company has been reporting numbers. One thing which I can say about the management of Zomato is, their execution has been impeccable. And that is something which gives us confidence every quarter. And in fact, we have added Zomato in our portfolio at 50 rupees, 75 rupees, 90, 100, 120. Even at 140, 150, we have added Zomato in our portfolio. for the simple fact that this was addition over different quarters, and as we saw execution, continuing to do well on the food, on the Blinkit space, I think it gave us more and more confidence that this business will turn profitable. It turned profitable on the food business a couple of quarters back. In the last quarter, it turned Blinkit positive on the operating profit. So I think overall on a consolidated basis also it has turned profitable. I think only piece which is not yet turned profitable is the Hyperpure business, which is the restaurant B2B business. I think that also in the next couple of quarters it should turn profitable by FY26. I think overall the idea one needs to see in Zomato is that if you take the food business as one and just see what are the options you have. If you want to order food today, there are only two players in the market, and Zomato is the market leader in an oligopoly market, which enjoys more than 56% kind of a market share. Now, they deliver around 160 crore, 170 crore orders in a year. Now, if they just increase the food delivery charges by 1 rupees, that entire 160 crore goes into their EBITDA. Now, that is something which very few businesses have the capability to do. That, by increasing your EBITDA by 150, 160 crore, by just increasing 1 rupees per customer, that's a large cash flow which gets added to your EBITDA. Now, they're going to replicate the same in the quick commerce also, which is your Blinkit. Now, Blinkit is the largest player in your quick commerce, Zepto being the second largest and Instacart being the third. Now, within Blinkit, if they do a similar thing of, charging 1 rupees or 2 rupees higher for every order, I think customers will not get impacted, because I doubt anyone bothers about paying extra 1 rupees, 2 rupees if you're getting the convenience of getting the item in your house within 10 to 12 minutes. So these are both, I would say, businesses which don't have much of a competition. Blinkit is the 40% market share in that space. And I think the good part is that Blinkit can become bigger than the food business for a simple fact that if I look at a household expenditure, we spend very less on ordering food or eating out, and in which we are using Zomato for bookings. So eating out or ordering food on Zomato is a very small wallet share of every household. The groceries is a very, very large wallet share of any household. Now, Blinkit is targeting that wallet share of the groceries. And that is something people order almost every day. And, I have known people ordering multiple times in a single day also. So Blinkit has become, or I would say the quick commerce has become an addiction, wherein earlier the same households used to go on a weekend or once in a month to a big bazaar, to a kind of a physical such store to buy the groceries for the month or the week. Now the same thing, people can do it sitting at home, sitting in your car, sitting in your office. You are reaching home in 10-15 minutes. You want something, you open your app in your car, you order. By the time you reach home, your item is also there. So these are convenience factors which can't get replaced, and these are addictions. Once you get used to this behavior, you can't go back to your brick and mortar stores. So I think this is something which has a large addressable market. There's always a debate that, what is the real addressable market for the quick commerce. I think the groceries which is there for households, that is a large addressable market. It can take market from the brick and mortars. It can take market from other players. It can take market from the local pop and mom stores. But I think it definitely can become much bigger than the food ordering business as of today. So I would continue to hold Zomato in my portfolio, and that is something we have been very bullish and for a long time, and we continue to be bullish on it.
From your AIF, would you be investing into the IPO of Ola Electric?
No, I would say that, we have evaluated obviously different auto companies. I like auto ancillary companies more than the auto OEMs. So I have allocation into auto ancillaries, but not into auto OEMs. Now within that, we are definitely not built up any positive view on Ola Electric at this point of time. So obviously once listing happens, we'll have to look at it from a more long-term perspective. Now, why I would say that is overall on EV, I'm not very positive. I think, overall EV is one space which I have not been very positive for a long time. And in fact, for the last couple of years, one thing which I've been talking whenever we have been talking about autos is that the EVs cannot replace IC engines. EV was a big kind of a transformative thing which was happening, but I would say that EVs cannot replace IC engines. I would rather say it is going to be the hybrids and the hydrogens which will replace the IC engines. For the simple fact that EV is actually not environment friendly, or it saves power. To charge batteries, you need to produce power in some part of the world, and that leads to a lot of carbon emission in that part. Second part is with regard to the batteries, the amount of minerals you need to mine for making those batteries itself has a lot of environmental cost. So I would say that EVs definitely is not so environment friendly as it was assumed to be. If you see also, most of the major auto companies internationally have massively cut their R&D budgets on EVs, because they have also realized that EV is not going to replace IC engines. From a customer perspective, there was a recent survey, I think in Economist or in some other magazine, wherein it shows that 65% of EV owners wish to migrate back to IC engines. So with all these data points, I'm not in a I would say camp who's very keen on electric auto companies.
Any new sectors that you think which are today hidden and maybe underweight or kind of very very low in their weights in NSE 500, BSE 500, which you have figured out because yours is sector rotation as an approach?
So I have been very bullish on the whole power space. And I think when I see many of the investors' personal portfolios, or when I look at some of the mutual funds or PMSs, one thing which I've seen is that many of them are very underweight on power. Now, power is going to be one space wherein some of the largest capex is going to happen. And if you see the amount of capex which is planned for all sources of power, whether it is thermal, solar, hydel, wind, any power source, I think the amount of capex which is going to be there is going to be exceptionally high. So I think power should be one of the major sectors which should be there in portfolios of clients. I have a decent allocation into power. Now, when I say power, it is not only about the power producing companies. It is across the entire value chain of power. Now, when I say value chain of power, it means companies, because see, when you produce power in any power plant, could be a thermal, solar, hydel, wind, anything could be there. Transmission of power is required from the source of production to the households or to the industries where it is going to be consumed. So this entire value chain of production, transmission, distribution, converting it, keeping the power within a particular voltage, everything comes into play, whether it's the transformers, wires and cables, companies putting up the power towers, or companies who are supplying the raw materials to the companies, or also EPC companies, power EPC companies, which are actually into the construction of all these power plants. There are many companies which are supplying components to these power plants. So all these entire value chain of power, I'm very bullish on. And as a house, we have been quite positive on the power sector. And I think that is one sector I would say it seems a bit underallocated in portfolios.
Sure, Anirudh. I think it has been really pleasure conversing with you. But final comments from you, or maybe your overall experience of this bull run, the way it has kind of built its, I would say, momentum and pace. We have seen so many hurdles coming, and all hurdles have been crossed. And now it looks like we are absolutely forgetting that markets can ever fall. It's like month on month, I have never seen this era in my history and my career of last almost 2 decades, that every month we are seeing client statements with returns of 3 to 5% month on month, 3 to 5%. Like we released a report this month like any other month, and we mentioned that we are kind of seeing happier, wiser and richer investors, and that kind of keeps us elated. But at the same time, we have not mentioned this in our note, but it keeps us worried also, because this kind of 3 to 5% is
Every
raising
month.
expectations of our clients as well as expectations of investors. And many new investors have come in the stock market. Many investors have kind of I would say enhanced their asset allocation towards equities, seeing the entire run up which is going on. So how do you want to kind of conclude this webinar is what I leave it to you. I do not want you to kind of have any bias, but
Yeah.
if it is really different this time, then maybe it is different. So from that point of view, it's like we have to be courageous also, but at the same time we have to be cognizant also. I am kind of short of questions. I thought of asking you questions around risk, because we have covered, a lot of things around the potential, I would say, upside from here on. But yes, like, maybe few quarters ago, there were questions around elections, around budget, which were the hurdles which markets have already crossed. But at this juncture, it looks like markets are like in a habit of giving returns, and maybe that is scary. So over to you to kind of sum it up.
See, basically, one thing which I would want to, conclude by is that, you can't take 100 or a zero call in equity. Like, you cannot be all invested and all out of equity. You need to remain invested, increase the cash, decrease the cash, do profit booking. So I would advise investors that, anything which has run up very fast within your portfolio, one should need to book profit also, or do the weight management. Now, I'm talking things which I actually do in my portfolio. Anything which has moved up very fast, I do not hesitate to book profits. Investors should also book profits. Now, when you book profits, it doesn't mean that you sell it and you keep it in cash. Look for alternate investment ideas where the valuations are not very rich, and where there's not much of kind of a big bubble which has been made. So it should be, whenever the markets go up a lot, idea should be to get out of expensive stocks, get into companies where the valuation comfort is there. The second thing is that investors should be aware that if you are entering the market even at these levels, be ready for a 5 to 10% kind of a correction. You should not panic. Those are the corrections which is the hurdle or the way the markets behave. If I see the last 25 years, markets will look like a one line. The moment I increase the zoom, it will look like this. The moment I increase the zoom more, it will look like this. So markets definitely don't go up in one way. There will be ups and downs. Be ready to have a 5%, 6%, 10% kind of a correction in the market. But yes, those will be times wherein, if you have idle cash, if you have extra liquidity, those will be times to deploy into the market. Having said that, I would say that definitely from a 4-5 year perspective, there's nothing which beats the India story. We will definitely be among the top 3 economies over the next 4, 5, 6 years. And I think by 2030, if all goes well, I think we should be among the top 3 economies. And within that, definitely each sector will participate. I remember Mr. Rakesh Junjunwala used to always talk about the mother of all bull runs. It's very unfortunate that we don't have him with us at this point of time. But India is actually going through the mother of all kind of the bull runs. So I think we are fortunate, all of us, we are fortunate to be a part of it. We are fortunate to be in the middle of it. And one needs to remain invested into India. One needs to remain invested into different sectors, companies. Get out of companies where valuations are too expensive during such times. Get into companies where earnings are better, valuations are better. And yes, when things go down again, you can change your allocation again back to something where, because see, whenever the markets will fall, anything which is expensive will fall more. So idea is to get out of it before it falls. And then once the correction happens, you can again come back into it from a much longer perspective.
Thanks, Anirudh. You have given your fund manager's view. I'll give my, advisor lens view to, some of our viewers and clients that, when markets have run up the way they have, where everything has gone up, it's, I think, a brilliant opportunity for clients, investors, to anybody and everybody, friends and family, whoever is watching this, to kind of get rid of your own personally managed stocks. Because what has happened, like, we have been holding these stocks for A or B or a C reason. We may have inherited these stocks, or we may have bought this stock on somebody's tip, or as an investor, one at times becomes like a fund manager and tries to kind of invest in stocks on one's own. But when markets have run up so much, I'm telling you, based on my personal experience and experience with many of our clients over the last 2 decades, whenever market will turn from here onwards, but in self-managed portfolios will hurt very badly. So this is an opportunity, like what Anirudh is saying, book your profits. The right thing to do is to kind of book profits from the self-managed portfolios and give it to the fund manager, because fund manager is better placed to actually understand future and maybe have less emotion. And the focus is not going to be on price, focus is going to be in business growth. And that is where, fund managers add a lot of value. Thank you so much, Anirudh, for your time today. And thank you everyone for joining us today. We know all of us are like optimistic and have a long-term horizon. So there is kind of no reiteration required on that. But yes, a reiteration is required to those clients who today are feeling that maybe they need to book, profits from some of these managed portfolios of, some of the fund managers. I don't think that's required. But if at all portfolio, needs to see a profit booking, that needs to be on self-managed portfolios. Thank you so much, Anirudh, again, and thank you everyone for joining.
So thank you, Kamal, for having me.
Pleasure.